Is this stock cheap right now, or is it still a little too expensive? That's a common question among investors, and to answer this question, we need to turn to the discipline of valuation. The mother of all valuation approaches, that's probably the PE multiple. At least it is the most commonly talked about approach to determine whether a company is expensive or cheap. When you turn on CNBC, for example, you can be certain that the PE multiple will be mentioned within minutes. But in this video, I will show you with the help of a book from a fairly unknown investing guru how one magic ingredient can turn an expensive looking stock on a PE basis into a bargain opportunity, and why there is a general tendency of stock markets to underprice quality businesses. Alright, let me just tell you what the video structure looks like. First, I'll just very briefly explain what the PE ratio is actually about. Then I will share a couple of very powerful numbers that illustrate why some stocks with a PE of 30 or 40 even might be incredible opportunities, while other stocks with a PE of 10 might still be overpriced. And then finally, I have a confession to make, so if you don't want to miss out on that, stay tuned. Okay, let's kick things off by defining what the PE ratio actually is. Well, in a way, it's a back of the envelope valuation approach, as you can take the current stock price of a publicly traded company and simply divide it by the annual earnings per share of that business. Usually you would use the trailing 12 month of earnings, and then you end up with the PE multiple. So for example, if a company is currently trading at $500 a share and its earnings over the past 12 months were $40 a share, well then the PE ratio for that stock would be 12.5. $500 divided by $40. Now I think there are two things worth highlighting here. First, as a general rule of thumb, with all else being equal, meaning corporate debt, growth, return on invested capital, or cyclicality, the lower the PE ratio, the cheaper a company is. That's a fact, at least under the just mentioned assumptions. And secondly, one can say that as the PE of a company goes up over time, it shows that investors' sentiment is turning more favorable. And a declining PE multiple is of course an indication that the sentiment is turning bearish and investors are becoming more skeptical of the company's outlook. Now, I've just said at the beginning of the video that if you consume typical finance media, it almost seems as if the PE ratio is one of, if not the most useful way to find undervalued stocks. Almost every book on the discipline of value investing seems to discuss the PE ratio in some of its chapters. And especially new investors immediately feel competent when they are able to use the PE ratio as a valuation approach to rely on when they try to determine whether a stock is cheap or expensive. But I would argue that investors' attitude towards the PE multiple almost seems to follow the Dunning-Kruger curve. At first, it gives investors this large boost of confidence, but the more experienced investors become, the more they understand why a single number doesn't tell them all that much. With more experience, you understand that you need to make sure that the denominator of the ratio, for example, the earnings, well, they need to be based on adjusted and normalized earnings to remove one-time effects. And you also understand that high PE stocks, although they look optically expensive, can actually be incredibly cheap. In fact, I would argue that most super high quality businesses will almost always appear to be expensive on a PE basis. And I think in this context, one needs to bring up the following graph that Terry Smith, CEO of Fundsmith, likes to use in his presentations. It shows what kind of PE multiple you could have paid for some very well-known businesses and brands back in 1973, and you would have still ended up with a satisfying compounded annual return of 7% over a 40-year 6 period. For example, you could have paid a PE of 281 for L'Oreal, 174 for Brown-Forman, 100 times earnings for Pepsi, 44 times earnings for Procter & Gamble, and a mere 31 times for Unilever. And this is something that Mohnish Pabrai, he realized as well. The funny thing with the investing business is that sometimes you can buy something at 20 times earnings and it can be cheap. Alright, so let me explain why a 30 times earnings stock can be cheap. And to do this, we will look at an example from the book Nothing But Net by Mark Mahaney, and that's the underrated investing guru that I mentioned previously. He presented two companies, an optically expensive tech stock that is earning $1 per share and is available for $20 per share, so it is trading at a PE multiple of 20, and a regular $15 stock that is also generating $1 in earnings per share and is thus optically cheaper as the PE is only 15. Mahaney then presents a table that shows how an expensive looking stock can be turned into a reasonably priced stock with the help of consistent above average earnings growth. In this table you can see that if the expensive looking stock can grow its earnings at 20% for 10 years, it will trade at a PE of around 4 in year 10, assuming the share price stays flat. The regular stock, on the other hand, grows its earnings at 10% annually, and despite the lower starting valuation, we can conclude that with the benefit of hindsight, the stock was actually more expensive than our tech stock, as in year 10, the stock trades at a PE multiple of 6.4, more than 50% higher. And we're not finished here. Of course, this is only a hypothetical example. In reality, it seems fairly unlikely that both companies will not see their share prices go up as their earnings power goes up. In fact, businesses that can grow at high rates usually trade at higher multiples and continue to trade at higher multiples if they can sustain that above average growth. And of course, this impacts the long-term stock returns for shareholders. Mark Mahaney writes in his book, if tech stocks can hold their premium multiple, then any premium growth they generate can translate into premium stock performance. He presents another table in his book that shows what would happen if both the tech stock and the regular stock would hold their starting valuation multiples. And as you can see, if the expensive looking stock can hold its multiple, shareholders enjoy a total return of 416% over that 10-year period compared to just 136% for shareholders owning the optically cheaper stock. Now, as I said at the beginning of the video, I have a confession to make. Yes, I absolutely used Warren Buffett as a clickbait in my thumbnail, and I want to apologize for that. Of course, Warren Buffett understands that high and low multiples don't tell investors anything about the true value of a stock. He's even quoted saying, typically, the term value investing connotes the purchase of stocks having attributes such as a low ratio of price to book value, a low price to earnings ratio, or a high dividend yield. Unfortunately, such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it is worth and is therefore truly operating on the principle of obtaining value in his investments. Correspondingly, opposite characteristics, a high ratio of price to book value, a high price to earnings ratio, and a low dividend yield, are in no way inconsistent with the value purchase. Alright, if you want to learn more about the art of valuation and specifically how you can value unprofitable stocks, I recommend you watch the following video next. Take care.